Here's something that surprises many people when they see it for the first time. Two retirees, identical IRA balances, identical investment returns, same age, same spending needs. One of them will pay substantially more in taxes over the course of their retirement than the other. Not because their investments performed differently, not because the tax code treated them differently, but because one of them managed the timing and character of their income deliberately, and one of them didn't. That difference is not theoretical, it is mathematical. And for retirees with large IRA balances, it is often one of the largest financial decisions remaining in their plan. Today, I wish to go deep on the mechanics, how RMDs accelerate over time, what the conversion corridor actually is and how to find it, why your tax bracket understates your true marginal rate, and what a coordinated multi-year plan looks like in practice. This is a technical video. It rewards careful attention. Let me start with the problem that makes this planning both necessary and urgent. Required minimum distributions are not static. They are calculated each year by dividing your prior year-end IRA balance by an IRS life expectancy factor that shrinks as you age, which means two things happen simultaneously. Your IRA balance may continue to grow with investment returns and your divisor keeps declining. The result is your mandatory taxable income can grow significantly over time, even if you never touch the account voluntarily. At age 73, the IRS divisor is 26.5. On a $2 million IRA, that's approximately $75.5 thousand in mandatory ordinary income in year one. By age 83, the divisor is 17.7 on that same balance, potentially larger from continued growth. The RMD approaches $113,000 or more. Stack that against Social Security income, investment dividends, and capital gains. You see how a retiree who felt comfortably in the 22% tax bracket at 73 might find themselves persistently in the 32% tax bracket a decade later. Not because they made poor decisions, because they made no decision. As Michael Kitces has described, a low tax bracket available today is lost forever if not used in the current year. The retiree with a large IRA who waits passively for RMDs is effectively choosing to pay future taxes at the highest available rate. The tax trajectory for a large IRA is not flat. Without intervention, it slopes upward. A Roth conversion is mathematically attractive when you are paying tax today at a rate lower than you would pay on the same dollars in the future. That sounds obvious, but identifying the exact amount to convert each year, not too little, not too much, requires finding what I call the conversion corridor. The conversion corridor is the income range where converting pre-tax IRA dollars to Roth costs less today than it would cost as a future RMD at a higher rate. It is not a fixed dollar amount. It moves each year based on your income sources, bracket boundaries, and projected future trajectory. There are three zones. Too low. Income is below the 12% bracket ceiling. Gain harvesting at 0% may actually be more valuable here. The corridor. Taxable income is in the 22 to 24% range, materially below future RMD driven brackets of 32% or higher. Converting to fill the bracket ceiling makes mathematical sense. Too high. The conversion amount would push current income into 32% or above brackets. Today's rate may equal or exceed the future rate you're trying to avoid. Stop converting. In practical terms, you start with your projected ordinary income for the year, Social Security, dividends, interest, pension, and ask, how much additional income can I add through a Roth conversion before I reach the top of my target bracket? For a married couple in the 22% bracket in 2026, the ceiling is about $211,000 in taxable income. If their ordinary income is $130,000, they have roughly $81,000 of corridor room before crossing into the next tax bracket. The appeal of a partial Roth conversion is that it lets you remain in lower brackets while whittling down the IRA balance that would otherwise produce higher rate RMDs later. Converting the entire account at once almost always pushes current marginal rates above the future rates being avoided, destroying the arbitrage the strategy depends on. The corridor is not a shortcut. It is a precision instrument. Used correctly, it harvests tax rate arbitrage that cannot be recovered later. Here is where retirement tax planning gets genuinely counterintuitive. Your tax bracket tells you what rate applies to the next dollar of ordinary income, but it does not tell you what that dollar actually costs, because a dollar of additional income in retirement often triggers consequences beyond the bracket itself. First, the ordinary income bracket itself, 22, 24 or 32% at the margins most relevant to this discussion. Second, the Social Security tax torpedo during the phase-in range where additional income makes more of Social Security taxable. Each dollar of added income can trigger up to 85 cents of additional Social Security taxable income. At a 22% rate, that adds roughly 18 to 19 cents of extra tax per dollar of income. Your stated bracket is 22%, your effective marginal rate may be closer to 40%. Third, the IRMAA cliff, which I'll address in detail in the next segment. Just because someone is in the 22% tax bracket does not mean their true marginal rate is 22%. During the Social Security phase-in range, a retiree may face an effective marginal rate of 35% or higher on income that appears to fall in the 22% bracket. This changes the conversion calculus entirely. A retiree who thinks they are converting at 22% may actually be converting at 35% or more. The corridor is narrower than the brackets. Before sizing any Roth conversion, the relevant question is not what bracket I am in. It is what is my true marginal rate on the last dollar of this conversion after accounting for Social Security phase-in, IRMAA thresholds, and ordinary income bracket. That number requires a pro forma projection, not a bracket lookup. The bracket is the floor. The true marginal rate is the ceiling. And in retirement, those two numbers are often very different. IRMAA, Medicare's income-related surcharge on parts B and D, operates differently from every other element of the tax code, and that difference makes it particularly dangerous for retirees who are not watching it. Every other tax system in the United States is progressive at the margin. Only the income above a threshold is taxed at the higher rate. IRMAA does not work that way. IRMAA is a cliff. $1 over a threshold and the full surcharge applies. For a married couple on Medicare in 2026, crossing the first IRMAA threshold by a single dollar costs nearly $2,000 per year in additional premiums. Crossing the second tier costs nearly $5,000. The 2-year look back makes this particularly treacherous. Your 2026 IRMAA is based on your 2024 margin. A Roth conversion, a large capital gain, or a one-time IRA distribution taken in 2024 can produce unexpected surcharges 2 years later, even if your income in 2025 and 2026 return to normal. That does not mean conversions that temporarily trigger IRMAA are always wrong. Sometimes 1 year of surcharges is a worthwhile price for a substantial reduction in future IRA balances and future RMDs. But that trade-off has to be modeled explicitly, including the 2-year lag rather than discovered after the fact. IRMAA is a hidden bracket. It does not appear in the tax code tables, but it absolutely appears in the bill. Let me bring all of this together with a hypothetical illustration for educational purposes only. Imagine a married couple, both age 63, recently retired. They have 1.8 million traditional IRA, 300,000 in taxable accounts, and 200,000 in an existing Roth. They plan to delay Social Security to 70. Without any intervention, their projected RMD at age 73 is approximately $90,000 and growing. From age 63 to 67, their income is at its lowest. No social security yet, no RMDs. They convert systematically, filling the 22 or 24% bracket each year, stopping before they hit 32%. They pay the conversion tax from a taxable account to maximize the amount moved into Roth. For ages 68 to 72, Social Security begins, income rises. The corridor narrows. They recalibrate the conversion amount each year based on the new income picture. QCDs become available at 70.5 for charitable giving. At age 73, RMDs begin, but the IRA balance is now between 1 and 1.2 million rather than 1.8 million or more. The mandatory withdrawal is 30 to 40% lower. The tax bracket trajectory is materially better than the default path. KITS modeled a similar scenario. A retiree with 1.5 million IRA who began a systematic conversion at 60 reduced a projected $132,000 RMD at 72 to approximately $84,000, avoiding the 32% tax bracket entirely. These are illustrative projections based on specific assumptions. Individual outcomes will vary. The plan does not eliminate taxes. It replaces uncertain, accelerating taxes with known, manageable ones. We covered a lot of ground today. I want to leave you with one question. If someone ran a 10-year forward projection of your taxable income right now, mapping your RMDs, Social Security, investment income, and bracket trajectory year by year, would you be surprised by what you saw? In my experience, most people who go through that exercise for the first time are surprised. Not always alarmed, but surprised. So here's my snap poll. Which of these three describes what you're doing today or where you are today? A, I have a multi-year tax projection and an active Roth conversion strategy. B, I know I should, but I haven't built one yet. Or C, this was the first time I have heard the conversion corridor explained this way. Drop your letter below. No judgment, just data. I read every comment and your answer tells me exactly what to cover next.